want to do it at the podium? Yeah. Good to see you. Yeah. I don't need it. That's all right. Okay, I'm going to call the November 14th Audit and Finance Committee meeting to order. We're going to do this quickly, and Tim, just we're only going to do one presentation, which is the Raymond James presentation tonight. So I hope that works for you. We've reviewed your presentation, and we can, if you're all set with any items, does anything need to be voted on from your perspective? From me, no. I know not from you, Lucy, but.
For me, I mean, I don't have to do the presentation on the audit plan if you don't want. If you want to approve it, or I can just ask questions.
Okay, let me run through this. First, we need to have approval for the minutes of the July 11th meeting. Can I have a motion and a second to accept the minutes from that meeting?
I'll make a motion. You have a motion? I'll make a motion.
I'll second.
Thank you. All in favor?
Aye.
Aye. Okay. Lucy, we're going to, if you're okay with that, just I think we've all reviewed the presentation, so
Yes, that's fine.
we'll pass that. I'm going to see if I'm assuming there are no public comments, but I will ask.
Yes, sir.
Any committee questions related to the investment presentation? I hear none. Oren, since we've met before, I won't ask Lucy to do the introduction. Let's move on to a quick presentation on MBS, which is the asset class that we increased the range of allocation to. Thanks for coming and for your patience waiting.
Yeah, it's an interesting process y'all go through here, to say the least. I guess I was drafted to present the suggestion that the board consider increasing the policy limits of mortgage-backed securities in the investment portfolio from 30% up to 50% of allowable investments. Doesn't mean you have to engage in that, but it kind of gives a little more freedom to Lucy and what she does. And I think if you listen, it'll be pretty simple. I am going to go ahead and skip forward to this page right here. I guess it's page 5. And you can see at the very bottom, over the years, as we've been receiving your investment portfolio, you've kept mortgage-backed securities at about 30%. There's a policy limit of a 30% max. There was a time it went to 32, but that was like we knew securities were maturing, and we had purchased, or the district had purchased securities to replace them, and the overlap over that few day period right there made it come out to the math to be 32%. But you are allowed to purchase agency securities, as you can see on the top row there, up to 50%. And we believe that the reason why you should consider investing in mortgage-backed securities up to that level or allowing yourself the opportunities is because you're going to get more income. That's the bottom line. That's the cliff notes. It's a similar credit quality as the agencies that you allow at 50%. It's a similar implied government rating of AAA as are the callable agencies that you already invest in. We think the cash flow is smoother. In other words, think about your own home mortgage. You make a monthly payment. These mortgage-backed securities are an aggregation of those home loans, and they are insured by Fannie Mae or Freddie Mac, just like the callable agencies are insured by the issuing agency there. And so that monthly cash flow is coming in as opposed to at maturity date of a callable agency. If you buy a callable agency and there's a $10 million investment in that, at maturity date you get your $10 million back. If the issuing agency wants to provide you that money back sooner, in other words, they're calling it, and they would do that when rates are low, they're going to give you back all $10 million of that. John and Jane Doe, who are the collateral behind the mortgage-backed securities, pay monthly. And when rates go lower, they're going to go refinance, but 100% of that mortgage-backed security is not going to refinance. So you're going to have an investment that stays out there a little longer with a little higher yield than it would if it were a callable agency. We think that's a beneficial feature that will provide you more income and a higher yield in your portfolio that the agencies don't. So that's why we say at least give them this equal footing, if you would, of the callable agencies. The reason why you would want to consider doing this is going to be illustrated in the next two slides. So the line in blue is approximate yield of a representative mortgage-backed security over the last few years. The orange line is a representative yield of the callable agency over the last few years. The green line is the difference. You can see they've averaged about a 50 basis point increase or a 0.5% increase of additional yield in the mortgage-backed securities versus the callable agencies. If you were to translate that to dollars of income that the district could have earned over that time period, that's what's going on with the blue here. I've taken 20% going from 30 to 50. I've taken those dollar values each quarter and invested in that additional, let's call it 45 basis points or 0.5% of extra yield. That would have given you about, it looks like what we're running about $100,000 to $150,000 of income per quarter extra. So over the 3-year period, about a $1.7 million of additional earnings that you could spend. I mean, every time we've come and had visits with Lucy's, they're like, we need more money to fund projects with this and that. And this is, to us, was kind of easy pickings right here. Same credit quality, a little different in the machinations of how the product works, but you're going to get about $1.7 million you would have gotten about $1.7 million extra over the last 3 years. The mortgage-backed security market is second only to the U.S. Treasury market in the $41 trillion of bonds outstanding in the U.S. The Treasury market's about 35% of that, mortgage-backs are 23%. When you have that large population out there, that means it's a more liquid security. In other words, what that means is if you need to sell those, you can get a bid more easily since there are more buyers in that larger volume. The callable agency sector has diminished now down to about 5%. As a result of the crisis, the callable agencies were mandated to, some of them were mandated to reduce their balance sheets and shrink, if you would, so they didn't need to issue as much debt, so it shrunk down to about 5% outstanding. That's not going to go away. It's going to be there. You'll have plenty to invest in, but I just want you to see that as a percent of the market out there, the mortgage backs are far greater than the agency, so they are a far more liquid type security. So in summary, I'd say if you can allow yourself to increase the policy limits from 30% up to 50% of buying the mortgage-backed securities, you may provide yourself an opportunity to make additional income for the same credit risk. The cash flow works a little differently. You've got a smoother cash flow profile. And this is something that you already invest in. This is not a new product. This is something you have up to 30% of your portfolio already in. It's just increasing the limit a little bit. So, I told you I'd be brief. Any questions?
No, thanks.
Thanks, Mr. Edwards.
Love it.
That was helpful. No public questions. And I would just, Lucy, or sorry, Mrs. Weinberg, and I spoke about this. So just for the record, I know we're every little basis point helps with our funding. What we did discuss is that MBS is at a very tight spread and has been for a while. My only concern with increasing this dramatically and immediately is just an event that would cause extreme widening in the mark-to-market consequences. So I know that's not as a risk for the district, but it's something, at least on a mark-to-market perspective, that I just want to be sensitive to.
You raise a good point. And so we're talking about two different things here. What I've been talking about are the earnings that these two investment types throw off that are of a similar credit quality. And we believe the mortgage backs offer you a little more. So if you have the opportunity to invest more in that, you don't have to. I mean, the situation may be, for whatever reason, that you prefer the characteristics of the callable agency, so you don't invest. It's just allowing yourself to when the situation provides it, because it provides you more current income. Both of these securities have unrealized gain or loss. They both are fixed income, and in the land of fixed income, when prices go up, rates go down. So we've been in lower yield levels now, so unrealized gains are in a lot of portfolios out there. But they're unrealized. They're realized only if you sell them. You hardly ever sell a security until it's at the very end when the tail's gotten out there. Most municipalities like you don't sell securities very frequently. You're not a trading institution. You kind of buy and hold is a phrase we tend to use. generally speaking. So if rates go up, if market rates, if inflation comes into the economy and it drives long-term rates up, and so when you go to buy that same security, you can buy it at a higher yield, that's good. But the securities you have in your portfolio now, if you were to go sell them, they would probably be at a loss. So they have an unrealized loss if you had to sell them. That does not affect your income at the end of the day, because if you hold on to that security that has an unrealized loss, it's going to mature at par. You will get your principal invested dollars back. You only would incur that unrealized gain or loss if you sell the security at a time when there is an unrealized gain or loss. And that's just, you will always have one or the other. You will virtually never have a security after you buy it that is at no gain or loss if it's a longer term fixed income security, because market rates always are moving up and down literally daily. So you buy it, the next day rates are a basis point too different. Maybe they're 5 basis, maybe news comes out, we've got another tweet, we've got a change in rates, and all of a sudden you've got a change in, anytime you have a change, anytime the treasury curve moves, you have a change in unrealized change in the value of your security. So those are two important components, but the income earned is permanent, you can go spend it. The unrealized gain or loss doesn't affect you unless or until you sell that security. If you hold it to maturity, it dissipates, it erodes as it reaches maturity.
Okay.
Make
thank
sense?
Yes.
I have a couple of questions.
Yep.
So how long is the investment?
So the district has typically invested in callable agencies. I think there's a policy limit out to 5 years. So you may buy a 5-year maturity callable agency. So if it does not get called by the agency, in 5 years from now, you will get your money. If you bought $10 million of it, you'll get $10 million of principal returned to you. Mortgage-backed securities, think about your home loan if you have one.
Yeah.
They pay out over time, and we in the industry view those as an average life. The securities that you have, the mortgage-backs that you have an average life of 5 years or less. That means the average, half of the principal on average is coming back by that average life date. So for the example that I use right there is a 15-year mortgage-backed security whose average life is anywhere from 3.5 to 5 years, depending on how you project John and Jane Doe to make their underlying prepayment. So it does, that's one of the, I said different characteristics earlier. The mortgage-backs have a longer final principal payment date, which will be a very small amount when that very final last payment is made. But on average, you're going to get your principal dollars back within the same time frame as your 5-year callable agency out there. Does that make sense? Because it's you know, it's a different animal, but think another way, another benefit. When that swap counterparty calls that callable agency, they're going to give you all of that back at one time when rates are low. And they're going to go reissue new debt at a lower rate that you can invest in. John and Jane Doe do not all come rushing in. If you've bought $10 million of a mortgage-backed security, think of that. That's hundreds and hundreds of underlying loans or the collateral. Some of those people will go refinance. Some of those people don't have the cash to go through the fees to go refinance. Some of them aren't thinking about it. They just aren't in tune with the ability to do that. So you wind up over time having investments that are earning you an above market yield because they should have been refinanced and taken away from or given back to you. You're giving your principal dollars back, but they're not. So it's pluses and minuses of each. The callables have a hard final. There's no tail, we call it the tail. But.
Any other questions? Thank you, Mr. Edwards, for your brevity and clarity and your patience today. I hope you make your flight.
That's good. We're good.
Okay. Tim, so as we talked about, I don't think we require a presentation, so I'll just call you and ask what you need from us in terms of approvals.
The approval of the negotiated work order contract audit, as well as the fiscal 2019-2020 audit plan. I don't have to do the formal presentation
Okay.
if you're comfortable with approving those items.
I've had a chance to review both of those, but first on the negotiated work order contracts, any committee questions? No. No?
No.
So can I have a motion to approve the audit of negotiated work order contracts And a second, please.
I move to approve.
I'll second it.
And all in favor?
Aye.
Aye.
Aye. So that passes. Similarly, for the fiscal year audit plan, any questions publicly or from the committee?
Chairman, for the record, there were no public comments.
Okay. I guess I have to formally ask you, I'm sorry. And no public comments for the fiscal
No, sir.
year audit. Any committee questions? I hear none. Can I call the question to approve the fiscal year audit plan?
I move to approve.
I'll second it.
All in favor?
Aye.
Aye. And that passes as well. Any public comment on remaining items?
No, sir.
Sorry for the disjointed committee meeting here, but I will adjourn. And the next Audit and Finance Committee is scheduled for Jan 31st next year. And it looks like we'll be announcing the location at that time. Adjourn the meeting. Thank you.